Speaking of gold, I'm told our live shot from Kansas City now is as good as gold. So we go back to William Black, and I want to apologize for losing you just a moment ago. Let me go back over what we were talking about. The two banks out with their earnings. JP Morgan, their earnings soared 33%, and Wells Fargo profits up 23%. But one of the things that we're seeing here, and I want to get you to talk a little bit about it, is, despite these low interest rates, it seems like there are fewer borrowers refinancing. What do you make of that?
They've used up some of the low-hanging fruit. Many borrowers, even though it would make economic sense to refinance, don't realize that, and so they don't come in. And there's still a problem in qualifying for the loan these days because so many homes are underwater. That means that the amount they owe on their mortgage exceeds the value of the property, and they can't refinance.
Well, William, that's a really good point because it used to be you could come in if you had a pulse, you got a loan. Now it seems like you have to jump through all sorts of hoops. But is this a worrisome sign for earnings from the rest of the banking sector? And does it spell problems for the housing recovery?
Yes to both of your questions. These percentage increases sound large, but you have to put them in context. They're coming from a dismal place in which most of the stock value has been lost in a significant number of our largest banks. And these are trillion-dollar enterprises. So while the earnings sound large as a percentage matter, they're actually not particularly good. And yes, the latest buzz from the real estate industry is they're afraid that instead of speeding up, refinancings are actually slowing down. Again, that'd be consistent with the idea that they'd used up the most obvious pool of people who were sophisticated and had homes worth more than their loan amounts. And of course, that's a subset of the people that might refinance.
Now, will the banks, in your estimation, need to loosen the strict credit standards in order to increase loan growth going forward and in order to help with the recovery in the housing market?
No, the banks can't do that. That would be repeating the disaster that caused this crisis. But the United States certainly could create a system that said, even though your house is underwater, if you continue to make your payments, we're going to provide credit to you, for example, through FHA. And indeed, a lot of that has been happening over the last couple years.
Now, William, one of the things that we're also learning, both these banks reporting that business customers are more cautious about spending. And just this week, we're seeing signs that U.S. small business coming out as well, that the confidence index, that it was stalled for the first time this month in March because of the uncertainty in this economy. Small businesses, as you know, produce half the private GDP and employ half the private workforce. How concerning are these pieces of information?
Very concerning. It's not really uncertainty, it's lack of demand. It's fairly straightforward. If the consumers don't buy things, the businesses won't spend money to make them. And consumers are not buying all that much. Consumers are not going more heavily into debt terribly much. And we've now had, very recently with the sequestration battle, the fifth shoe dropping of austerity. And there's a proposal from the Obama administration to impose a sixth form of austerity, and they are strangling the economic recovery and putting us in the direction of Europe, which has created a gratuitous recession throughout the Eurozone through austerity, and actually far more than Great Depression levels of unemployment in much of the periphery of Europe.
William Black, an associate professor at UMKC, joining us from Kansas City. Can't thank you enough.